Welcome to the deep dive. I'm Lee, and on my blog, bullishbooks.com, well, I spend a lot of time looking into data-driven ways to build wealth. And speaking of wealth, have you ever really thought about how, a fairly small amount of money can turn into something huge? Think about Peter Lynch. I mean, this is the guy who ran Fidelity's Magellan Fund and got an average annual return of 29.2%. Just incredible. He took $18 million dollars and turned it into what, $14 billion dollars. So today we're really going to get into the core ideas from my article on bullishbooks.com. It's called How to Beat the Market. Peter Lynch's proven investment strategies for 20% plus annual returns. We want to figure out how you, as an individual investor, can actually use his thinking to maybe get some pretty amazing results yourself.
Yeah, that's exactly right. And what's so interesting about Lynch and what your article really digs into, Lee, is that his success wasn't about some, super secret Wall Street magic. It was based on an approach that's surprisingly, well, understandable. It really changed how people thought about who could actually succeed at investing.
Exactly. And the article, it lays out the basics, but today we want to push a bit further. We'll dig into some of the maybe less obvious points and try to simplify these really powerful ideas even more. So they're not just like interesting theories, but things you can actually use
Mm-hmm.
pretty much right away.
Yeah.
Our mission here is, well, simple. Pull out the essentials from Peter Lynch's playbook and help you think differently about investing. Maybe even beat the market. We really want to make this stuff clear and useful for you, without making your head spin with jargon.
Okay, sounds good. So let's start with this whole idea of beating the market average. Lay, you mentioned Benjamin Graham in your article. How does his thinking kind of set the scene for Lynch?
Right. So Graham, the father of value investing, his main focus for most people was defensive investing. Minimize risk, aim for solid, average returns historically, something like 9.8% a year. And look, for a lot of investors, that's perfectly fine, a good strategy. But Graham also talked about the enterprising investor.
And that's key, right? The enterprising part wasn't just about taking bigger risks.
No, not at all. It was about a much deeper commitment, putting in the time, the brain power to really analyze investments rigorously.
It meant investing more of your own time and, well, your intellectual energy into understanding how markets work, how specific companies tick.
Exactly. It's like the difference between, say, casually walking football and being a pro scout who's analyzing game film for hours, right?
Mm.
Enterprising investing needs that level of engagement, and that's really where Peter Lynch comes in and kind of changes the game.
So how did Lynch build on that? How did he take Graham's enterprising idea and make it, well, more accessible?
The absolute core of Lynch's philosophy, the thing that really opened up investing for regular people, was invest in what you know.
Hmm.
It sounds almost too simple, doesn't it?
A little bit, yeah.
But the power is in its directness. He argued that some of the best opportunities are literally right in front of us. The products we use, the services we see succeeding every day. His famous Dunkin' Donuts example. It wasn't just about the financials. He was a customer. He saw how popular they were. He understood their place in the market just by being there.
So how did that empower someone who maybe didn't have a finance degree, that focus on just observing?
It really did level the playing field. For so long, investing felt like this exclusive club for experts with fancy tools and inside info. Lynch basically said, hang on, you see businesses all the time. You know which ones are busy, which ones people like. That direct experience, that's a huge advantage. I remember this little independent bookstore near where I used to live. Wasn't part of a chain, but man, it was always packed. They had great events, loyal customers. Just seeing that, a thriving business in my own neighborhood, that's exactly the kind of signal Lynch was talking about.
And it's such a contrast to the usual advice, right? Which is often just, trust the professionals. What was Lynch's view on blindly following expert advice?
Oh, he was pretty skeptical. I mean, look at the data. A lot of mutual funds actually struggle to consistently beat their benchmarks. And we all get bombarded with those hot tips, right? They almost never pan out. Lynch even famously told people not to just copy his stock picks.
Why not? Why would he say ignore even his own buys?
Well, a few things. First, even the best investors, like Lynch, get things wrong sometimes.
Yeah.
Nobody's perfect.
Okay, makes sense.
Second, timing. By the time you hear what a pro bought, the best price might be long gone. But the biggest reason, he argued, is that you, the individual, have something valuable they often don't. Your own real-world experience with companies doing well. Think about, I don't know, Starbucks when it was taking off, or Netflix early on. Regular people were using them, seeing the growth way before it was obvious on Wall Street reports.
Your article mentions some great stories from his book, One Up on Wall Street, that really illustrate this. Can you share those?
Yeah, absolutely. There's the classic one about the factory worker, I think in New England somewhere. He just noticed this local hosiery company was always busy, always expanding, based purely on that observation. Seeing a local business thrive, he invested over time and, well, did incredibly well.
Wow.
And then there's the flip side. The story of the investor whose wife kept telling him how great this new women's clothing store was. She loved the products, the service, everything.
Oh, I can see where this is going.
Right? He ignored her. He was busy chasing whatever Wall Street was hyping up that week. That store's stock went up like 100 times over several years. He finally bought in after the experts recommended it.
Right near the top, I bet.
Exactly. Right before it peaked and crashed. Tragic, really.
So the lesson there is pretty clear.
It really is. The most valuable insights, sometimes they come from just paying attention to the world, not just from financial reports or listening to every analyst. What seems obvious in your daily life can be a signal Wall Street hasn't caught on to yet.
Which brings us nicely to this idea of going beyond the numbers in stock selections, something you cover in the article. Can you expand on that?
Definitely. Look, when I first got into finance, coming from a more quantitative background myself, I sort of assumed it was all about mastering complex models. The math had to be the key. But what I learned, and what Lynch really drove home, is that understanding the story behind the numbers is often just as critical, maybe even more so.
It's fascinating he emphasized that, given his own success in finance, that it wasn't just about the quantitative side.
Totally. He actually observed that sometimes people with backgrounds in things like history or philosophy did better than pure math types. He even said, famously, that fourth-grade math and basic logic are often enough. It's more about understanding the business itself, its position, its potential, not just running spreadsheets endlessly.
Okay, but professional fund managers have teams, resources, computing power. Why do so many of them still underperform if it's not just complex math?
Yeah, it seems counterintuitive, right?
Yeah.
But there are structural things. They often feel pressured to stick with big, well-known stocks. It's safer for their careers.
Ah, the nobody got fired for buying IBM idea.
Kinda, yeah. They might need official research coverage before they invest, which takes time. And there are regulations that limit what they can do or how quickly they can move. That's where you, the individual, have an advantage. You can act on your own observations much faster before it's common knowledge on Wall Street. It really comes down to developing those skills of observation and applying logical thinking, not just relying on fancy models.
So moving on from picking stocks, let's talk about the investor themselves.
Yeah.
Your article stresses certain personal qualities. What are the key attributes needed for success, according to Lynch?
Right, this is huge. You can have the best strategy in the world, but if your temperament isn't right, you're probably not going to succeed long term. Patience is number one. Just being able to hold on to the ups and downs.
Easier said than done sometimes.
Oh, absolutely. Then self-reliance, trusting your own research, your own thinking. Common sense sounds basic, but incredibly valuable. Tolerance for pain, or maybe tolerance for short-term losses, because they will happen.
Definitely.
Open-mindedness, being willing to learn and adapt. Emotional detachment, making rational calls, not decisions based on fear or greed. Commitment to doing the actual research yourself. Humility, admitting when you're wrong. Flexibility, changing your mind if the facts change. And maybe the most important, staying calm when the market is tanking.
And how do these qualities tie back to Lynch's focus on understanding the specific companies you own?
They're completely linked. If you really understand the business, its strengths, its weaknesses, its long-term plan, you're much less likely to panic sell during a dip.
Right. You see beyond the stock price ticker.
Exactly. You understand the underlying value. Lynch always said the market goes up long-term, but the ride will be volatile. These personal qualities are like shock absorbers. They help you handle the bumps without getting thrown off course. So working on these traits, cultivating them, that's really the foundation for successful investing.
Okay, now let's get practical. Your article outlines Lynch's 6 stock categories. Can you give us a quick rundown of those and what to look for in each?
Yeah, this framework is super helpful for organizing your thinking. First, slow growers. These are usually mature companies, maybe paying decent dividends in stable industries. You're looking at dividend payouts, consistency.
Okay.
Then medium growers, or stalwarts, as he sometimes called them. Growing steadily, say 10–20% a year. Look for reasonable PE ratios, smart acquisitions, consistent growth, and how they handle downturns. Fast growers. These are the ones with high earnings growth, 20–25% or more. But they're not always in hot industries, think Marriott or Walmart, in their big expansion phases. Here you need to ask, is the core business driving the growth? Is it sustainable? Can they keep replicating it? How much market is left?
Right, assessing that runway.
Exactly. Then cyclicals. Their fortunes rise and fall with the economy. Automakers, airlines, steel companies. You need to watch inventory levels, supply and demand, their competitive position, and be aware their PEs can look misleadingly low at the top of a cycle.
Tricky category.
Can be. Turnarounds. These are companies in trouble, but with potential for a comeback. Think Chrysler or Toys R Us back in the day. Focuses on survival, debt, cash flow. Is there a clear plan for recovery?
High risk, high reward, potentially.
Potentially huge rewards, yeah. 30-50x isn't unheard of if they pull it off. Finally, asset plays. Here, the value is in the company's underlying assets, maybe real estate, resources, patents that the market isn't appreciating. You analyze the asset value, the debt, and look for catalysts that might unlock that value. The real power here isn't just memorizing the categories, it's understanding them so you can focus your research where you have an edge, where you understand the story.
And to analyze companies within those categories, you need to look at specific financial metrics. What are the crucial ones you highlight?
Right, these are the tools you use. First, product revenue concentration. You don't want a company relying too heavily on just one product that's risky. Diversification matters.
Okay.
The price to earnings, PE ratio, is fundamental. Lynch liked PE ratios that were roughly equal to the company's growth rate. Much lower might be undervalued, much higher, overvalued. He also liked that quick check, growth rate plus dividend yield, PE. If that's over 2, it could be attractive.
Useful shortcut.
Yeah. A strong cash position is great. Gives them flexibility maybe for acquisitions or buybacks. And it effectively lowers your purchase price for the actual business. If a stock is $32 but has $16 in cash per share, you're really paying $16 for the business operations.
Good point.
Understanding the debt structure is vital, especially the debt-to-equity ratio. Lower is generally better. Also, knowing if it's bank debt versus bonds matters, particularly for turnarounds. Inventory management, watching if inventory is piling up, can signal slowing sales. Pension obligations, underfunded pensions, can be a hidden liability. And pre-tax profit margins. High margins show efficiency. But for turnarounds, even small improvements in low margins can drastically boost profits.
So it's about looking at these together in context.
Absolutely. No single metric tells the whole story. You need to see how they fit together for that specific company and industry.
Okay, finally, let's talk about timing, when to buy, when to sell, and the overall legacy of Lynch's ideas today. What was his take on trying to time the market?
He was really clear on this. Forget market timing. It's a loser's game. Trying to predict the highs and lows is basically impossible consistently. The best time to buy is simply when you find a good company selling at a reasonable price. That's it. He used a gardening analogy. You plant when the conditions are right for the plant. You don't try to guess the single best day of sunshine for the entire year.
Makes sense. What about selling? When did he think it was time to let go of a stock?
His selling discipline was also tied to the fundamentals. You sell when the reason you bought the stock in the first place isn't true anymore.
Like, what specifically?
Maybe the company's financials start to seriously weaken, or growth stalls out for a fast grower. Or maybe the company starts making dumb acquisitions way outside its expertise, what he brilliantly called diversification.
Diversification. Love that.
Yeah, it's memorable. It's about selling when the story changes for the worse, not just because the stock price wiggled.
So pulling it all together, why do you think Lynch's philosophy is still so relevant today with all the noise and speed in modern markets?
Because it's grounded in timeless principles, common sense, understanding actual businesses, focusing on long-term value, not short-term noise. That famous line, "The stock doesn't know you own it," it's such a great reminder to be objective. Focus on the business performance, not your emotional attachment or how the stock price moved yesterday.
It's the opposite of just buy, hold, and pray.
Exactly. It's active, informed ownership. His ideas give you a solid framework for today. Understand what you own, keep your emotions in check, think like a business owner, stay within your circle of knowledge, and keep a long-term view.
So ultimately, success boils down to that discipline and understanding value.
Patience, discipline, and really understanding the business value. That's the core of it. Okay, so just to recap our deep dive on Peter Lynch, we've hit on the power of investing in what you know. Why doing your own homework trumps just following tips, the importance of your own temperament, those 6 useful stock categories, and the key numbers to watch. And remember, these aren't just, academic ideas. They're practical principles you can start thinking about and applying to your own investments, like today. If you want to dig deeper into all this, the full articles is up on my site. bullishbooks.com. You'll also find lots of other stuff there on building wealth, startup strategies, all data-driven. So yeah, please head over to bullishbooks.com, check out the article, and subscribe if you want more insights like this. And maybe just leave you with this thought. As you go about your week, look at the businesses you interact with every day. Could one of them be that overlooked gem Peter Lynch might have spotted? Something to think about.